Hey guys, Toby Mathis here, one of the partners over at Anderson Business Advisors. And a lot has been going on with President Trump and his taxation. If you read the article that was released by the New York Times, obviously they're painting things in a certain light. And it's worthwhile to take a step back and unpack kind of what's been going on and why the tax system is the way the tax system is. Number one, we can always go back to Chief Justice Rehnquist, and it was in an oral argument, I believe it was Old Dominion, where he made a very straightforward statement, which is there's nothing wrong to avoid taxes. The Internal Revenue Code does not prevent strategies to avoid taxation. And so sometimes we used to joke tax avoidance is okay, tax evasion gets you orange jumpsuit. But what it really boils down to is if there are code provisions that incentivize certain types of behavior, there's nothing wrong with taking advantage of it. And what we seem to have here is that exact scenario where President Trump, in his past dealings, took advantage of certain types of tax changes, tax law changes, to carry back losses farther than had been previously allowed. And let me set the table for this. Let's say that you're a business and your business makes $1 million every year for years 1, 2, 3, and 4. In year 5, we have a recession. And all of a sudden, your business loses $4 million. And I'll hit what that actually means in a second, because you can have paper losses. It doesn't mean that you ran out of $4 million. It means that maybe you bought a bunch of equipment or you invested in something that created a paper loss because there was tax incentives behind that purchase. Under old laws, it used to be able to carry things back, let's say 2 years. So you have remember, we have 4 years of $1 million every year of profit, and you're paying the taxes each of those years. In year 5, you have this $4 million loss. And under the old law, you could carry that back 2 years and wipe out those 2 years of 1 million each. And then you carry forward the amount that you weren't able to use up going forward. So remember, we had $4 million of loss and we're covering 2 years. So all we have to do is say 4 million becomes 2 million, and that loss is carrying forward because we had a really bad year. What ended up happening in President Trump's situation is his losses were incurred during this Great Recession. And Congress, and it wasn't him, it was Congress that decided we are going to unlock and we're going to allow businesses to carry back losses for more than 2 years. I believe it was 4 or 5 years. I think it was 4 under the first one. Where we are sitting right now, by the way, you could carry back losses 5 years as we sit here in 2020. So back then, you all of a sudden have a scenario where he had profit, 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 maybe even more years of profit. And then you had a year where you had loss, paper loss, and he was carrying it back 2 years. And then they said, oh, by the way, you can carry it back an additional 2 years to 4 years. So let's go back to our example. We made 1 million in year 1, 1 million in year 2, 1 million in year 3, 1 million in year 4. In year 5, we lose $4 million. Under the old law, we could carry it back 2 years. Now we can carry it back 4 years. So now we have a situation where in 5 years, you're offsetting every dollar and you pay 0 in income taxes. And that's because you're able to take the losses. Now let's discuss losses. Hopefully that makes sense to you and you realize, wait a second, all he did was take back and carry back some losses to offset some years where he had profit. Yeah. But if I take those deductions now, it means I'm not taking them at some other point. And so if you look in the article, you'll realize that in many of the years, he did have profits and was probably tens of millions of dollars of taxes paid. If you listen to the lawyers, and we'll see what else comes out, my hunch is that there's tranches of money coming in and there's accumulated or accelerating certain types of deductions in certain years so that you have more cash on hand to continue to do developing. And all that is the way the tax code is written. It's incentivizing somebody who's in business, and in Trump's case, developing, or President Trump's case, he's a developer. So it's incentivizing him to continue to expand his real estate and his other business enterprises. But the real estate's where the real secret is. And here's why. When most people think of losses, they think, oh, a business must be hemorrhaging money. That's not necessarily the case. Let's say that we have a doctor. We can all agree doctors do pretty well for the most part. So let's say that you're a specialist and you do, we won't even pick a particular type of doctor. We'll just say that you're a doctor that does X. And there's a machine that doctor can buy for $1 million. The doctor's not going to spend $1 million on the machine. The doctor may buy it with no money down and spread out the payments over 10 years. The way the tax law is written, that doctor may be able to take that entire $1 million and write it off as a deduction in year one. There's something called accelerated depreciation in Section 179 expensing that enables you to do that very thing. So let's say that doctor is, in our previous example, they're making $1 million a year. So let's say that they're making $1 million year 1, 2, 3, 4, and here comes year 5, and they're going to make $1 million again. Maybe they have a boon of a year, and they want to lower it. Maybe they make $2 million in year 5, and they buy $2 million of equipment, and they expense it all. We have something called bonus depreciation that allows them to expense 100% of that thing in year 1, even though they made $2 million. Keep in mind, there's $2 million that may be sitting in the bank account, but on paper, they buy an asset, a piece of equipment for their business, and they spend $2 million on it, and it wipes out all their income. So their taxable income is now zero. They didn't make any money. And you'd look at them and say, wow, that business is doing really poorly. It made zero money. Well, think of Amazon, Apple, and all these big companies, Microsoft, all these others that managed to show zero profit too, or close to it, or significantly reduce their revenue. We know that they're cash cows, but they're using the tax laws in their advantage. In the case of Donald Trump, we're seeing that it was done, or President Trump, we see that it was done domestically. It wasn't using any offshore finagling like they do with intellectual property for the most part. In fact, President Trump apparently paid quite a bit in overseas taxes in the UK and India, amongst others. But it was his United States taxes that he was able to harvest a bunch of losses. So it wasn't that his business was hemorrhaging, is that he was incentivized to do an activity, and he was given tax incentives to do it. Now, if we all went around and we said, hey, you know what, as a society, and we really want electric vehicles, and we want to incentivize people to put solar on their house and buy electric cars. So we're going to give you a tax credit if you do it. We don't yell at the people for using the tax credits, right? We're giving them an incentive to do a certain activity. In the case of the tax code, there's an incentive to continue to invest your money and your resources to buy additional equipment or other or build buildings or develop warehouses, whatever it may be. In President Trump's situation, he's building buildings, and these are big, risky endeavors where you're putting hundreds of millions, if not billions of dollars into these projects. And all that it says is, hey, if you're at risk and this is your line of business, you can accelerate that depreciation. In other words, when we build a structure on a piece of land, the land never changes in value, really. Like maybe it goes up, but you're not improving the land. Where the improvement is when you build something on top of it. And the IRS in Congress, I should say, Congress writes this thing and says, hey, you can deduct things over their useful life. So if I buy a car, for a business, it might last 5 years. So we're going to let you write off 1/5, 1/5, 1/5 until it's completely deducted. We might give you an incentive to say, or you could just write it all off in 1 year. And that's actually called accelerated depreciation. When you have a building, it's 39-year property. They're going to say, hey, you write off 1/39th of the building every year, but they may allow you to accelerate that depreciation as well. They may allow you to break the components of that building. It's called a cost segregation, and take a massive deduction in year one, or accelerate it over 5 years or 7 years or 15 years, and break down components of the building to accelerate them, the deduction in the amount of tax relief you get into earlier years. So you can free up resources to do what? To go out and continue to buy more buildings, more land, and more developments. And if it was you or me, we might not get to use those losses and carry them back against previous years. We may have to carry them forward. We may not even get to use those losses in this year, because they are, a lot of them are considered what's called a passive loss. So with real estate, it's considered a passive activity. And so you're just carrying forward passive losses until you either have passive income to offset, or you get rid of the item, and then you can harvest any losses that you have on the books. It's kind of tough to do in real estate, but it does happen from time to time. So if, again, I'll use the example of the doctor. Let's say the doctor making $1 million a year, in year 5 makes 2 million, but buys a $2 million piece of real estate. The doctor's not going to get a $2 million loss. In fact, that doctor may not get to use any of the loss from the building if they were able to accelerate any of the depreciation or write off a portion of that building or whatnot against the doctor's other income. There's an exception to this, and that's when you're a real estate professional. And that's apparently where Trump is going to fall into as a developer. More than likely, he's going to fit into that category, or his businesses are going to fit into that category. And if that's the case, then we're using some of those passive losses to offset other income. I don't know, because the returns haven't been released, but that is apparently the case. And all he's doing is exactly what Congress is incentivizing. And so now I don't understand why we're mad and people are angry saying, well, he's not paying taxes. He's absolutely paying taxes, but he's also taking advantage of the laws as they're written to incentivize certain behavior. And he's doing exactly what the law is requesting. So I don't see illegality. I see taking advantage to avoid taxes and maybe defer them. Maybe he'll be paying more taxes in 20 years. I don't know. You wouldn't get mad at somebody who puts money into an IRA and takes that deduction, right? You wouldn't get mad at somebody who writes off their mortgage interest because they take advantage of the code either. But for whatever reason, because of the large amount of money that he's able to shelter, people are getting mad at it. The other area that was of particular interest to me, for example, in particular, was this thing of his conservation easements. And that is by taking large deductions for restricting the use of property. And the best example I can give you is, let's say you have a cattle rancher that has a bunch of land, can't afford to maintain it. That cattle rancher may get a bunch of people together and say, hey, you put in money, I'm going to put a restriction on the development of this land so I don't have to sell it. And I'll give away the rights for development to a conservation company so that my cattle lands don't get turned into condominiums, right? You're restricting it. Or maybe I say you're not going to mine the granite that's underneath there. You're not going to go and exploit that land for its resources. And you're not going to develop it and build a bunch of suburbs on top of it. I want this to be open land. We wouldn't have a problem if you put it that way and said, hey, you know what, that's good. We need open lands. It's going to a conservation company. The cattle rancher may get a little bit of money so they don't go broke during their lifetime. An investor may be able to get tax deductions for doing that noble deed of putting some money in and buying up some of this land and then putting restrictions on it. We might say that's activity that we want to have happen because we want to conserve property. Well, in President Trump's case, there's golf courses, and he put restrictions on the ability to develop some of these properties so that you couldn't put a suburb on it. You couldn't subdivide it and sell a bunch of properties on it. And in return, he was able to receive a charitable donation because he gave those rights to a conservation charity and said, here you go. It's a land conservation company of some sort. And he's entitled to a deduction for his gift based on its fair market value. And the only way to determine the fair market value is you say, if we develop this land, what is that land worth? Versus if we restrict its use, what is it worth? And the difference between those. So let's say that if I sold all this land and built condos on it, it's worth 20 million. But if I conserve it and say it can only be used as an open air, either as a golf course or as a park or something, it's only worth 10 million. Well, I went from 20 million to 10 million. I'd get a $10 million deduction because I just reduced the value of my land this year. And that's what I'm entitled to. I get to do it once. And apparently he does this with all of his golf courses, which is, again, behaviors that we would say that's good. You may be mad because it's a golf course and you say only rich people are on golf course. But what it does is it says, hey, that land, there's restrictions on what it could be used for, and it's gone. He can't just take it back the next year and say, no, hey, I regret that. I didn't mean to do that. No, it's gone. He gave a gift. It is irrevocable. You don't get to come back and say, hey, we really do want to build condos on it. Nope, his land, he put restrictions on it, and he was able to harvest an incentive to do it. And you see a lot of folks griping about that. The last thing I'll touch on, and then I'll say that, hopefully you're seeing where I'm coming from as a tax attorney, is the payment of third parties for consulting fees. And there's a lot made because some of these consulting fees are going to relatives or people that may have a relationship with Trump. There's nothing wrong with that as long as it's arm's length and there's consideration being exchanged and it's a reasonable amount. So you have to look at it and say, what's a reasonable amount? What could be paid? Could you pay a third party to do these things? If the answer is yes, and it's reasonable and you can pay a third party, then you can pay a relative to do it if they're doing the similar activities. And so if he was taking 20% of his project fees and paying off to consultants or consultant companies, and God knows he has about 500 different entities, and they're all paying different types of taxes. There's payroll taxes, there's property taxes. His buildings probably have lots of city taxes, state taxes, real estate taxes. There's old age disability and survivors benefits, Medicare. There's all sorts of unemployment. There's workman's comp. There's all sorts of things, perhaps L&I. There's all sorts of things that these businesses are paying. Plus, they're paying their Secretary of State fees. Some of them are paying franchise taxes, additional taxes, everything else. You look at all this, and then you break it down and you narrow it down to an individual personal income tax return and say, because you took all this other risk and you paid all these other expenses, here's your benefit for doing it. Here's the incentive so that you will continue to expand instead of just sitting on your cash. And it seems like it's an unfair portrayal of what's actually taking place. And I'm not going to sit here and get into politics. I'm just saying the tax code is written to incentivize certain behaviors. For example, charitable giving, mortgages, even some property taxes. It has built-in incentives for businesses. We want you to buy more equipment. We want you to build more plants. We want you to go out and acquire more real estate and develop things. And as a result, you get certain tax benefits. And why would we begrudge somebody for following the law and taking those incentives? That's what makes kind of gives me a head scratcher. And it seems like we're demonizing people for doing exactly what our elected representatives incentivize them to do. So look, my name is Toby Mathis. Again, if you want to learn about these concepts, there's nothing wrong with taking advantage of them in your life and in your business. All the incentives are there for you to engage in certain types of behaviors. And if you'd like to learn more, by all means, click on one of the links here and learn more through Anderson Business Advisors.